All right. Welcome everyone to the Thursday Elite Zoom training. Today, I wanted to go over how to do an illustration for FNG, Fidelity and Guarantees Pathsetter IUL. It was a special request by one of the agents, and they're just asking, how do you do just the easy illustration? Right. How do you make some illustration for IULs that are just straightforward, easy to do? So if you wanted to do it your own, you want to be able to duplicate that. So I wanted to show you on the screen. So let me share the screen real quick. Okay. So first of all, we're going to go to HQ under Sales Tools, Carrier and Products, Carriers, FNG. And here you're going to see Agent Login. And this takes you to the Fidelity and Guarantee website. You're going to click Login, Financial and Insurance Professional. If you are a new agent, you should already have a contract with FNG if you submitted your Sure LC more than 7 days ago. Um, and then on here, you're going to go to Sales Tools, go to Illustrations, and you're going to click on FNG Life Illustrations. So as an example, when you're doing a Mutual of Omaha IUL Express or Americo's Instant Decision IUL, they're pretty straightforward. You just can go to the quoting tool or the website and just quote them out right away. But FNG doesn't have that tool. It's a little more custom. So you have to come in here to do an illustration. Okay. You click Start New Case. And we're going to use Jane Smith as an example. Let's just make the client 40 years old. Okay, I'm just using that. And let's make her female. State, you can choose whatever state that you'll be writing the business in. Index Universal Life and find available products. The one that we primarily use is the FG Pathsetter. So you're going to click Select. I'm going to show you an illustration. If the client says, Sean, I would like to get an IUL and kind of max fund it so that later it could supplement my retirement income. So let's just say client said that to you. Then my recommendation is you're going to scroll down and under solves, there's something called solve for. There's a drop down menu. So you want to go to something called the max accumulation and income. Okay. So what it does is it calculates what's the maximum amount of accumulation and income that this policy can give the client and based on the client's affordability. Okay. So when it says solve for, we're trying to specify the monthly premium to get the face amount that the client is going to be getting. So it's like a calculation. Either we have to choose the specific premium that client is willing to pay and get the face amount as a solve, or you choose the face amount, then the software will show you how much premium they'll need to pay to get that face amount. So I leave it at face amount most of the time because I'm going to be putting the monthly premium that the client wants to put in that they can afford. So under specify premium, you click on this three dots and you see it shows you the years. So this is the anniversary and the age. of the client. So the first year, we're going to go ahead and click on the monthly premium. Let's just say client wanted to put in $200. And I'm just doing this as an example, okay? So let's just say client can afford $200 a month. So then you click this, 200, right? Everything should have changed to 200. Then now you go down and click OK. So that means we are forcing the illustration to show how much face amount and how much cash value will grow based on a $200 a month budget. Okay. And pay premium to, this is something that you guys should remember. Pay premium to literally means how long is the client gonna pay the premium until, right? So if you're gonna be doing a particular solve, like I'll show you an example solve that I really like. Pay premium to, it says default is Y100. Y100 means year 100. This is a default. If you take a look at this little I icon there, what does it say? To indicate an age, type A in front of the number. And to indicate a policy year, put a Y in front of the numbers. So what does that mean? If a client said, I only want to pay for 20 years, then Y20 means this will illustrate only 20 years of premiums being paid into it and then stops. Okay. 20-year limited pay. If you put A65, that means age 65. So the client will pay the premium until the client is 65 years old. So typically what I do is I like to put here A65. So what does that mean? Client will pay from whatever age they are now until 65, they'll pay the premium, but then afterwards they don't put any more money, not even a dime. So at age 65, it stops. Okay. But there's something that you do want to be aware of is that if the client's age is already close to 65, then A65 wouldn't make sense. So what do I mean? If a client is already 57 years old and I only put A65, that means the client will pay only 57 years old until 65. That's like 8 years. It's not enough. The client didn't pay enough money in there for you to only pay 8 years and be okay. So in those cases, I will change this to maybe 80, A80 or something like that. So it will be age 80 years old that they have to pay. I usually recommend 20-year pay minimum, 40 to 60 at least, right? 50 to 70 or 30 to 50 at least. Younger the lower the cost. So if they're younger, the premium is less, right? The cost of insurance is less and they have more time to let it grow. That's why with the power of compound interest, the younger you start, more money they'll have in the future because money keeps doubling every 7, 10 years. Okay, 7 to 10 years. So for the sake of this training, our current client that we're working on is age 40 years old female right now, and premium is until age 65. So she'll be paying about 25 years of premium, but then stops. Income stream. You scroll down, you don't have to touch anything here like cash value at age. Income stream calculated. Income type is a loan because if you take it out as a loan against your life insurance policy, then you don't get taxed on that money and you never have to pay that back. Income mode, let's do it monthly and start age. You want this age. You don't have to put A or Y in front of this, okay? This is defaulted at age 65, right? So you want this number and this number to be same. So what does this mean? Client will pay premium until age 65. And this one, as soon as the age 65 ends, the income will start. So this 65 shows 65, but the income will start 66. Okay? For 25 years. 66 years old for 25 years. How long is that? That's until 90 years old. Okay? 25 years, this means the number of years they'll receive an income. You don't have to click anything else. You click OK. There's nothing you need to do here for now. You go down to the interest crediting options. There are a variety of investment options, right? Morgan Stanley with a different participation, BlackRock, Barclays, S&P 500, all their S&P 500 options. So if you were to opt into the best ones, this is what I recommend. I look at the illustration rate. This means what the insurance company has performed for these indexes, and they show this number. Usually this is more conservative than what they actually did, but this is the max illustration rate based on the last 20 years of history. So what we're going to do is if you take a look at this, which ones have the highest? You see these two are over 7. The other ones are like 6, 5. So I'm gonna take it off of the put zeros on the lesser ones, put 50% on the Morgan Stanley equity 110% participation. And then I'm gonna erase the BlackRock S&P annual point to point. Seems good. It's doing well. So I put 50-50 on that. So it always will add up to 100%. Okay, you don't have to do anything else. I'm gonna go up here and view and print illustration. So if this illustration was done correctly, it'll be a 40-year-old female. She wants to just put some money aside for her retirement. And by 66, she wants to already start withdrawing income. That's what we're solving right now. So you can save and view as a PDF, and that makes it easier for you to read the illustration. So Pathsetter, it's an illustration. It focuses on wealth transfer, cash value accumulation, and living benefits. If you scroll down on the second page, it says Jane Smith, Nevada, female, 40 years old, non-tobacco. What does it say in face amount? $214,889. We didn't choose that. We chose the premium, right? 200 a month. And this is the face amount that the client gets. So you want to scroll down a little bit. Let's go to the important pages. By the way, this is the page numeric summary. Usually it's the page 6 of 25. If a client agrees, you can get this signed and submitted with the application, or after the policy gets issued, they mail the policy to the agent unless it's specified on the application, and the agent needs to get signed here by the owner and date, and then you sign it here and date it. All right. So remember, there's different investment options inside of the IUL. If you scroll down a little bit, this is something that I show the client because they want to understand how the IUL works. And typically, if I'm selling a mortgage protection client an IUL for just having a longevity and able to have a policy for the rest of their life and have cash value to pay off their home early with their cash value inside of the IUL, I don't go into this much detail. Okay. This is clients who are specifically asking for an IUL for tax-free retirement or maximum cash value so that later they can use the money. That's when I will explain this, not with the MU IULE or the Americo IUL, instant decision IUL. Here, so the IUL, the reason why our clients don't lose money when the market goes down is because IUL is a fixed index universal life, meaning that if the market crashes and it was negative, because it's fixed index, it has a floor of 0 or 0.25%. So you can never go below that. You can never lose money based on the market downside. So how does that work? S&P 500. This is the actual S&P 500 index numbers in the stock market and how it has performed over the last 20 years. So it shows you that's the returns in the stock market. In 2008, there was a negative 39.93%. That's almost a 40% market downside. There, a lot of people lost all their retirement during this time. Okay. Next year, but it did 27. Next year, it did 11, right? And then it did really well. So it's an up and down. The market is up and down, and that's how the stock market works. And even with these high numbers, such as 25%, negative 17, negative 39%, it did an average of 8.42% in the stock market. Even having the risk of the market downside, clients are receiving about 8.42, and that's why S&P 500 is kind of like the gold standard of investment. So like 401ks, IRAs, 403b, a lot of these retirement accounts are using an S&P 500 index. Okay. To the right side, this is the index universal life with fidelity and guarantees indexes. So our client's money is not going straight into the S&P 500 in the stock market. Our client's money goes into a separate account that mirrors the S&P 500. So if the market does well, client gets interest. If the market does badly, client doesn't lose any money because their money is not directly in the stock market. So that is the easiest way to explain to your clients if they ask, so how do you, it sounds too good to be true. When other people are losing money, why wouldn't I lose money in an IUL? Is because it's fixed. It's in a separate account that is fixed. So it's contractually guaranteed to never lose value based on the market performance, right? But take a look at the first index, S&P 500 annual point to point. This is the one that we chose as a 50% of the portfolio. It says 12% cap. What does that mean? It means, I think that, let me just mute that. It means that if the market does better than 12% on this particular index, the client can only get up to 12%. Okay, so 12% is max. Even if it did 18, 20%, client will only get 12% max. Okay, but when the market is negative, like 2008, negative 39%, our clients didn't lose any money. They actually got a 0.25% return. Anytime the market goes negative, you get a 0.25% floor. But if the market does higher than 12%, then it gets only 12%. So that's the give and take. So it's not too good to be true. It's just more of a safer product than putting your money directly into the stock market. And even with the 12% cap, it averaged 8.08%. So to me, it makes sense because only for a difference of less than 0.5% difference, you have a safer investment vehicle that also is tax-free. That's the selling point. And to the right, it shows you different options in the S&P 500 you can opt in for. And this is even more interesting. Morgan Stanley US Equity Allocator Index. This is a actual index in the stock market. You see negative 19 plus 21, right? It did up and down, right? And what was the average over the last 20 years? This index, particularly in the stock market, is 7.35% average over the last 20 years. But our Morgan Stanley US equity allocator did what on average? 10.31. It did over almost 3% higher in interest on average over the last 20 years. The Morgan Stanley point to point with 110% participation, it did over 11% return on average over the last 20 years. So if our clients who have a 401k put their money into the Morgan Stanley index in the stock market, then they would have gotten only 7.35% over the last 25 years. Our clients got 10 to 11%. So did the client miss out by not having as of a risky portfolio? No. So BlackRock, Barclays. So you have these options available for your clients. Okay. And it comes with the accelerated benefit, such as critical illness rider, terminal illness rider, chronic illness rider. And these are free riders that are already in the policy if the client gets approved. And it tells you what it covers, such as heart attack, stroke, organ transplant, paralysis, ALS, aneurysm, tumors, significant burns, end-stage renal failure, invasive cancer, things like that. So if you take a look at it, the client can access up to 100% of the death benefit. So let's just say heart attack was pretty serious and the client got $700,000 uh, uh, on $1 million policy. If the client's death benefit was 1 million and the client got a $700,000 living benefit payout for heart attack, then the client's death benefit goes down to 300,000 because you already advanced the 700,000 from the death benefit. So that's how it works. If the death benefit happened to be more than 1 million, they don't pay more than $1 million. $1 million is the cap for the payout for living benefits. Terminal illness, if the client has 24 months or less to live, right? They can also get up to 100% of that. In chronic illness, rider, if the client cannot perform 2 out of 6 activities of daily living, then they can get up to 25% of the death benefit a year. So if it was $1 million policy, 25% is $250,000 a year. If the policy was like 200,000, then that'll be about $50,000 a year in income if you're in a long-term care situation. Maybe you need to go to like a nursing home or you need somebody to come to your house to take care of you, all those things. And this is how you read the illustration. So you want to always go to the page 11, tabular detail. And when people say it's an illustration, this is what they're usually talking about. On the left side, this is the age, 41, and this is the anniversary. Plan premium outlay, it shows $2,400 a year, right? That's what the client pays a year, which is 200 a month. There you go. There's 3 different columns. This first one is guaranteed assumption. This means that if the market did negative return the next 20, 30 years, back to back to back to back, and never once had a one good year. So this is a very extreme circumstance illustration, but they have to show it by law, okay? So I'm gonna disregard this because there has never been more than 3 to 4 years back to back negative in the history of stock market. And if that happens, most likely the world is coming to an end, right? So disregard that. The middle one is showing a lot more market crashes happening than it has ever done. I would say probably another 50% more crashes. But this is also not as realistic because it's not the number that they have done over the last 20 years average. The non-guaranteed assumption, current interest rate, this is the average over the last 20 plus years. So this is more accurate. Okay. Take a look at it. This is the account value. So client's account value is growing. This is surrender value. Surrender value means that if the client wanted to cash out the policy and just walk away, that's what they'll walk away with. Okay? Because there is a surrender fee in the beginning of the policy. That's why you see 0 here, only 612 here, 2300 here. But as the year goes by, the surrender fee gets lower and lower. And eventually after 15 years, there's no more fees whatsoever. Okay. The cash value and the surrender value is the same. So with this scenario, let's go to the age of 65. So the client pays premium. You see plan premium outlay. This is only a $200 a month, by the way. Don't forget. I usually recommend, just so you know, if a client, whatever their age is currently, I have them to put a zero behind it and make their monthly payment, make that their monthly payment. So 40 female, I'll recommend $400 a month in premium to make something significant enough to do it as a retirement. Okay. But I'm just showing you in case client wants just an affordable plan of 200 a month. You can do it, but you can also let the client know that they can put more money in there as they go. So my illustration was done starting at age 40, puts 200 a month, and then at age 65, able to stop paying into it. So at age 65, client pays their final payments, and at age 66, what does it say? It's zero, right? So there's no more payments client have to make. And at that time, client has about $100,000 in there. You see that? And at age 66, if the client decides to take out a tax-free income, client will get $8,830 a year, which is, I'm assuming, a little over $700 or so. Um, so that is the tax-free income the client can receive starting at age 66 and keep getting paid on it until the client is 90 years old. So at age 90, I just have the income stop because not many people live over 90. But if the client lives up to 90 years old, that means client collectively put in $60,000 in total premium between the age of 40 to 65 years old. That's the premium that she paid in. She would have withdrawn an income of tax-free of $220,000 if she lives up to 90 years old. So how many times is that? It's over three times, right? Almost four times. If the client put this $200 a month into just a savings account at Bank of America, how much do you think that will be? And how long do you think that will last for the client? Right? That's the power of compound interest. And like I said, I'm just showing you a very affordable IUL option for 200. And if you take a look at it, the client also has protection. So let's just say at the age of 70, client has a heart attack. So that means client would have withdrawn income of $44,000 in income. And then if the client has a heart attack, she might be able to take up to $164,000 from the living benefits from having a heart attack or stroke or cancer. So it also protects them while they're building this. So it gives you protection if the client passed away unexpectedly, right? That's number one. Number two, if the client got really sick with terminal, critical, or chronic illness, then you can get access up to 100% of this. But if the client didn't die, didn't get sick, and they're still alive, then this can also help them with their retirement. That's why I call it catching three birds with one stone, because it gives you that extra layer of protection and also that growth that maybe putting into a savings account or checking account or putting under their mattress will not do. Let's just say instead of doing this, client put $200 into a savings account with Bank of America with an interest rate of 1% or less. Then 2 years after that, client has cancer. What does the Bank of America savings account do? $200 a month for a year is 1,200. I mean, 2,400, right? A year. 2 years is $4,800. What is $4,800 going to do for cancer? But if they got this policy on the second year, client had cancer diagnosed, they have access up to 100% of the death benefit. And that's why it's very important that clients are setting this up for themselves for not only protection, but for growth. And the generational wealth part is when this client, let's just say this client has a 10-year-old child and started an IUL for them for like 50 or $100 a month for the child, right? And that money grows and it helps them with some of the college funds or things like that. Or maybe they want to start a business. They want to be like an Elon Musk. Whatever that is, they have access to that money and they have a gift from the parents, and that protects them with death benefit, living benefits, and cash value. And the child grows up and continues to pay into it because they believe in also tax-free retirement. The parents taught them, right? And that kid goes to college, graduates, gets a job, gets married, has another child. So this original person's grandchild now has an IUL starting at the age of 15 days old, less than 1 years old. And this grandchild is growing up and becomes an adult. Grandma, who started this whole generational thing, passes away, leaves a couple hundred thousand to millions of dollars down to her child, right? So her child's net worth is going to be in the hundreds of thousands, if not millions. And then that money eventually gets passed down to who? The grandchild and the grandchild's grandchild, right? And that's how the generational wealth can continuously pass down more wealth through the generations to come. And a lot of the times people think generational wealth, you need hundreds of millions of dollars to do it. It's not true. It can start as little as $100, $200 a month, but it's mostly the importance of the financial education that you give to the client so they understand the value long term. This is not a get rich quick type of thing. There's a lot of get rich type of things out there, and most of the time it doesn't last more than a couple of years because it come and go, right? It goes away as quickly as it came. Whereas this one is more of that longevity, more of that generational wealth type of product. And this is what I recommend to my clients because I believe in it. I have it myself, and this is something that can be there for them even in their, 50s, 60s, 70s, 80s, 90s, 100 years old. Okay. All right. Hopefully that helped. And last thing I wanted to show you, and then I'll wrap it up and I'll open up for some questions. If you go to the page 21 of 2020, page 21 of 25, they're going to show you the different options available when it comes to your premium payment. So you remember we did 200 a month, right? Monthly premium. So target is 2,500. So your client is paying right around the target premium. So what does target mean? Target is recommended amount of premium that the client should be paying into this type of IUL just to let it grow healthy over time and have the policy until they're 120 years old. That's target. 7 pay, this is the maximum amount the client can pay a year for the first 7 years of getting this policy. So you heard of MEC, right? MEC, Modified Endowment Contract. That's the absolute ceiling of how much the client can pay into a particular IUL without being taxed. So if the client wants to max fund this, she can pay in as much as $13,593 a year for up to 7 years, but that's absolute max. And they can't even put a dime more into that. Monthly minimum no lapse is this is the minimum amount the client has to pay on a monthly basis to keep this policy going. So let's just say 6 months from now, client lost a job and she's not making the same amount of money and she can't pay the 200. Then you can have her pay the $104 a month so that the policy can keep going. But later, in a couple months, if he gets another job and she can pay into it, then she can always pay more back into it to catch up. Okay? That's what minimum no lapse means. when it comes to the $104, this is something also another thing. If the client had the policy for more than a couple of years and they lost their job, but they're at a really serious tight financial position, they can't even come up with $100, $104 a month, then you can have the client to stop the automatic payment and use the cash value that is being paid into the policy and let it pay itself. You don't have to pay any type of premium to get it going. But eventually it will run out. So after you get back on your, feet, you want to continue to contribute back into it so that you don't lose the IUL. So that's very, very important, guys. Okay. So that's the things that I would highlight if you're going into as much detail. I went into a lot of detail because obviously I'm teaching you as an agent. But if you are talking to the client, I'm not going into this much detail, guys. This is just for your knowledge. And like the really good agents, they have a tons of knowledge in their, brain, but you don't have to share everything to the client. You can go over what's important to the client, what's very important for the client to know, and just focus on the few highlighted areas so that client understands much easier. Because if you go over in too much detail and client is confused minds will say, I need to think about it. Okay. So keep it very simple. So the things that you might highlight is the living benefits, what kind of benefits they'll get, and show them that they'll pay for 25 years and how much income they can get, how much money they will have in there, things like that. Not in too much detail. Okay, Jericho, you have a question?
Hey, Sean. Good morning. Good morning, everyone, the leaders here in our team. I just wanted to get a scenario because it runs a few times where it's important that the client, when this is one of the important things when you visit into their home or when you're in the meeting, it's important to have established of rapport so that the client can tell you pretty much what you can listen to those important cues before you write the policy. So, for instance, I run across a few clients during the conversation, during the rapport conversation, that I have to go to the doctor. I don't know if I can make that appointment. I so right there is a clue already to help the client before seeing a doctor. It will be beneficial for the client to get the policy for him or her to qualify before seeing a doctor, because once she meets the doctor, it could be already something that they could find a new type of illness that might affect the qualification that could increase the premium, if you know what I'm trying to say, Sean.
Yeah, yeah, yeah. Sounds good, Jericho. Thank you. All right. So some questions here. Nayeli asked, can you take out tax-free money like for retirement or after 20 years when they take out some money, will I be taxed? So yeah, Nayeli, so the under the tax code 7702, most important thing is you are taking it as a loan against your life insurance policy, and that's why it's not taxed. The money that you take out is not taxed because you are not taking out as a withdrawal, you're withdrawing it as a loan against your life insurance policy. So if you took out $20,000, then that $20,000 will also come off the death benefit. Okay, so if your death benefit was 200,000 and you took out $20,000 in cash value as a loan, then your death benefit will be now 180,000. But because it comes off from the death benefit and it is a form of a loan, a loan is a debt and debt cannot be taxed. Okay? So
Okay,
you won't
cool.
be taxed.
Um, so
Mhm.
if it was like maxed out an Americo 450,000 death benefit, and let's say
Mhm.
at age 80 they have like 100,000 accumulated cash
Uh-huh.
value,
Yeah.
is that still taking away from the death benefit or is it taking away from the
Yes.
okay.
Yeah, takes away from the death benefit and the cash value. So both number will go down for the amount that the client took out.
Okay, thank you.
You're welcome. If client dies after 6 months, only the beneficiary get the full face amount. Does the agent get a chargeback? That's a good question. So if the client died of a legitimate reason, then usually agents do not get a chargeback. But there is a time where if they found out that the client didn't say truthful answers on the application, then yes, there could be a chargeback on that because they refund the client's premium. So that can happen. And also another thing that could potentially do that is if you sell like an AIG guaranteed issue whole life policy, yeah, if the client dies in the first 12 months, I believe the agent gets a chargeback on that because it's a guaranteed issue. And if the client dies, insurance company has to pay the client's money back plus 10% interest. That, yeah, so that's a good question. Um, the replays, no, I do not have a place that I'm posting this as a replay for now. When you take out a loan, there is not a payment for the loan balance. Yeah, so there is a payment, but the payment can be made with the cash value that you have inside of the policy, Charles. So you don't have to pay that back. But if the client wants to pay that back, they can. Okay, but it's not mandatory. The policy cash value could still pay it itself, pay itself. All right.
Hey, Sean.
Any other questions? Yeah.
Um, I've heard people complain about like, oh, there's interest on that loan, but when you're looking at it, it would be less than the 10% penalty you'd get charged if you took money out of a 401k, et cetera. And
Yeah.
I've heard it's a wash because they computate your, I don't know if this is accurate, but they've heard it's a wash because they're doing your returns on your cash value at like 8% or whatever historically. So it
hmm
ends up being a wash. Is that close to accurate, or am I off on that?
Yeah, it's pretty close to accurate. Yeah. So let's just say it's 7% on average and the loan rate is 5%. The 5% loan rate is against the money that you are taking out as a loan. So let's just say you had $20,000 you took out, then the interest rate is only charged on the 20,000. But let's just say you have 200,000 in cash value and that gets an 8% or 7%, then not only it's a wash, you should be gaining interest on that. Okay, so uh, because of the averages has been higher than 7%, close to 8, even with a 5% interest on that amount that you take it out as a loan, it should not affect the growth of your cash value at that point.
And it would be often less than if you went and got a loan from a bank too.
Oh, I mean, yeah, it's not even, comparable. Like bank loans, like personal loans, I mean that could be easily 7, 8% interest rate on that. If you get like go to those payday loans, I mean they charge you, crazy amount of interest. So yeah, and the beauty of it is it's not money that they have to pay back, whereas the loan that they take out from those loan companies, you have to pay them back or you get in trouble. So
Yeah, you
there's
just
that.
hear those from the Susie Ormans who are like trying to pick apart IULs and whatnot.
Yeah.
And you're like, well, the 200 in the stock market, if you die, you're getting, like you said, 2,400 after a year, 200 a month versus 50,000, 500,000 in a life insurance policy, which obviously your stock market's not doing for you. Um, and then I
Yeah.
often see people complain too about the core questions from a lot of agents about chart one, where it shows like a 0% return and the policy lapses. And I know
hmm
you covered that to some degree, but you also, can you can you explain that just a one more minute, explaining like the stock market's never done zero, and if it did zero, we'd be in more trouble than your IUL.
Yeah. So historically, if you look at the S&Ps or NASDAQ or any type of index, there hasn't really been a time where there's more than 3 to 4 year back-to-back negative return. And you might have a couple bad years, but then you come back with a couple good years, right? So it's an up and down, up and down. So that particular index that we looked at, indexes that we used, this 0.25 is if the market was doing negative back to back. Every year it did negative, then you get 0.25. There was another negative, so you did 0.25. Negative. So this is assuming over the next 10, 20 years, 30 years, just being negative market. So it's very unrealistic because if the stock market does negative for 5, 10, 20 year back to back, most likely the world is coming to an end. I mean, even Great Depression was never like that. So that's just something that you should just be mindful of. And can we predict the future? Not really, but the history tends to repeat up and down, up and down. So the last 20 years is going to most likely be similar to the next 20 years. So we're just predicting based on how it has performed over the last 20 years. That's the best way to think about it. So this current interest rate, 7.3, this is the most realistic because this is also including the negatives and the positive years. Okay. That it still have done. Okay.
Yeah, it seems people will get scared for a few years, but then they get
Mhm.
1% at their bank and they go, hey, what stocks are down? And then they start piling money back into the stock market. And then after 3 or 4 years, it starts going up again. It's just like that seesaw effect, it seems.
Yeah. Yeah. And I believe in IUL, but if somebody doesn't, it's okay. If they believe in buying a term and putting into the stock market, they can absolutely do that. If they want to do an infinite banking, like a participating whole life, you can do that also. There's no one right answer, and it doesn't fit everyone into one product. We don't do that. But I also know that this can be beneficial to the clients long term. And if the client is more about protection and safety, not just the riskiest investment, then this is a great product. If the client is like completely a person that wants all the risk in the world, then probably it's not the best product. Okay. All right. And Charles, you have a question?
Yes. Uh, Now, on the 401k, that's tax deferred
Yeah.
for, so when I reach 65 or whatever, and I start to draw it out, then I have to pay in the taxes that I want to draw out on.
Correct.
How can me not putting that money in a 401k and putting it in here benefit me more because I would have to pay taxes on that income now? But how will that benefit me more by not use the 401k if the company that I work for matches my income, and I'll only put that in like 3%, 3%. I do that.
Okay.
But everything
Yeah.
extra I put in, because that's tax deferred, I'm going to not put it there. I'm going to put it in here. How will this benefit me better than not putting it in a tax deferred account?
Yeah. So you're just saying that if it's above the matching amount from the employer, why is it more beneficial to put it in here versus just putting it in your 401k? Okay. So that's pretty simple for me. Is number one, if the client is right now putting, let's just say they're matching $500 a month in their 401k, then that means 500 of the client's money goes in and 500 from the company's money goes in. So that doubles the input into your 401k. So that's free money. I always tell my clients to do that. But anything above that, they're not matching. You're continuously having to have the money tax deferred until you get it later. And if you were to try to take out the money before 59 and a half, then you're going to also have to pay penalty on top of your taxes. So if your penalty is 10% and your tax bracket is 20, the money that you're taking out prior to 59 and a half, you have to pay 30% off of it. So every 10 grand you take out, you have to give Uncle Sam $3,000, right? So there is not as much of flexibility on that part. Number two, it also doesn't grow tax free. So if you have the money tax free in an IUL, then you'll be able to use the money even if it's only you're 40 or 50 years old, you can still take out that money tax free against your life insurance policy. And 401k cannot do that. There is an option where you can take it out as a loan against your 401k. That is possible, but you'll have to pay the loan rate back to the 401k company. And the other part that I think is very important is if you were to have later as you retire, if a client had a life insurance for 30 years of their life during their work years and they retire, they don't take their life insurance with them, right? So the client's life insurance is no longer there. And by the time they retire, you would think it's the age that you need the life insurance and the living benefits the most, right? Because their age is going up and the chance of a heart attack, stroke, and cancer all go up. So that's another thing. That's why it's very important to have an IUL versus doing just a 401k, right? But if the client wants to do it to where let's just say they have a 401k of $200,000 and they are, let's just say 60 years old and $200,000 401k. Some clients, what they do is they actually pay the taxes once a year of, let's just say $50,000 they take out, pay the taxes, and the rest of the amount they put it into an IUL, max funded, 7 pay or 5 pay. And then next year you take out another money from the 401k, pay taxes, and put it into the IUL second year, third year, fourth year, fifth year. So let's just say you paid in 200,000 into it over 5 years into an IUL max funded, then the client will no longer have the tax liability of a 401k. So some clients strategically do that, moving the money out of the 401k into an IUL. So that is also another option available for them. Okay. All right, guys. So that was good questions. Actually, the underwriting is pretty good. If they had obviously like heart attack, stroke, cancer, those are gonna be hard no matter which IUL you go with. But FNG is, I would say it's pretty lenient. You can have diabetes, you can have these things. So yeah, I would say the underwriting is pretty comparable. Okay.
And Sean, F&G has actual live underwriters, so if you get automatically declined from Americo or Moo or something, and the guy's situation is not that bad, if you believe him, or if you just want to take a shot, you can pivot to F&G, right? And then you can
Yeah.
actually correspond with the underwriter and
Hmm.
get a policy in place where you wouldn't be able to do that with one of the automatic issues. I mean, I'd always go with Americo first, maybe, or
Hmm.
Moo, just
Yeah.
to get something in place today. But um, the underwriting is humans, so you can actually, you know,
Yeah, it's
correspond with
true.
them.
Yeah. And like I said, America IUL and Mutual of Omaha IUL is a great priced IULs. It's really focused on affordability and getting them a large coverage for an affordable price. So it's perfect for like mortgage protection or clients looking for permanent coverage at an affordable price. But for FNG, if a client has some health issues that uh, would otherwise get automatically declined with American Mutual of Omaha, then you can pivot to FNG and you can talk to the underwriter and give them some more detail so that you can explain about the client's situation. And there's a chance the client can still be approved. Awesome.
Awesome.
All right,
Thank you.
guys. Yeah, so I think that that's a little longer than what we usually spend on this, but hopefully this was a good training.
Hey, Sean, do
Um,
you have to bounce, or can I ask you one more question?
yeah, go ahead.
Okay. I hear a lot of agents, as soon as we get off these calls, they'll talk about things just like clients do when we're not there. Um, and they'll say, well, it mentions the policy lapsing or the payment going up after 15 years. But again, that comes back to the scenario of the stock market doing zero. And in my mind, I just think the government lets you sell this as a permanent policy, and but insurance companies who are risk averse and spend risk all day, they let you sell it as a permanent policy because they don't think the stock market's ever going to go down for 5 or 10 years straight.
Hmm.
Um, is there anything else that agents should process in their minds so they don't question that the fact that this is a permanent policy, do you think?
No, not really. Like I said, it's not for everyone. I believe that it's one of the best products, but if somebody doesn't believe in it, it's okay. I mean, we don't have to try to convince everyone that they have to get this, but I just share with them what the benefits are, and if that fits with their needs and wants, then I mean, most of the people, I would say 90% plus of the people that I ever talked to about this, they wanted this. Okay. The 10% didn't, but that's okay. Like I said, if somebody's super a big risk taker, or a client is very conservative where they just want to fix interest or dividend a year, like a CD, and nothing changes, then maybe this is not the best product, right? But for the general public, I think this is an amazing product because it gives you protection, it gives you that tax-free growth, and it's an overall great program that they can have it for the rest of their life.
Cool. And I know you usually don't put these up, but I don't know if you can put this one up for us just in our own group or something. But if not, you can't, then that's fine too.
Yeah, yeah. I mean, it's recorded, but it's a big file, so it'll have to be emailed out. I think that's the only
Okay.
way. And
Well,
Google Drive, actually Google Drive. So yeah, I'll get that
Sean,
posted on the WhatsApp
what about
group.
getting a Vimeo account? Because I would love to follow you and have all these uploaded into like a Venmo or Vimeo.
Yeah, yeah,
It's like
Vimeo, I think.
easiest.
Yeah, the
Yeah,
Vimeo account.
sorry.
Yeah,
I was
we can definitely look at that as well.
Yeah, just because it's a really, I mean, you guys do the best trainings, so I'd love to, send these out
Yeah,
to people who have questions and stuff like that.
absolutely. Yeah, that sounds great. Yeah, let's look into
Appreciate
that.
you though. I know
Yeah,
it's long. I appreciate you.
yeah, yeah. You're
hey,
welcome,
Sean,
guys.
could
Yeah.
you also mention that
Hey
pe
Sean,
people
hey
could just
Sean,
stay
really
here
quick.
in the dojo when they're done? They don't need to
You said what?
go. We all stay here and work together. The recording
Yeah,
might stop, but they can jump back right
yeah,
back
yeah.
into the dojo and work
Mhm.
together. Everybody doesn't
Yeah,
need to scatter, unless they want to. That's fine. But if they
yeah,
want,
yeah. Yeah,
anything,
you can
you're
stay in
amazing,
it
dude.
and yeah,
Thank
we
you
can
so
work
much, Sean.
together. Yeah, you're
Hey Sean,
welcome.
really
Yeah,
quick. Did I
yeah.
hear did I hear you say that this is not a permanent policy? This is considered a whole life policy, right?
It's not a whole life, but it is a permanent. Yes, permanent policy can be divided into IUL and the participating whole life.
Okay.
Yeah. So it
All
is
right.
a
So it's
permanent.
permanent, meaning up to 121, right? Or
Yeah,
whenever, however much they put in
that's correct.
okay, great. Amazing. Thanks so much.
Yeah, you're welcome. All right, guys. You have a blessed day. Talk to you later.